Welcome to this Friday, September the 15th, 2023, Friday 3 for 3. Koki Cox here with AlphaVest back on the East Coast, fresh off of Future Proof Wealth Management Conference in California, where I got to rub shoulders and have great conversations with 3,000 other advisors like myself as we were looking to improve our tech offerings, our communications, as well as portfolio and asset management. That said, welcome to 3 for 3. As usual, we are going to talk about the week in review. I'm going to start with winners and losers. You will see top of the list here. We're really enjoying Eli Lilly, which returned almost 7% over the last week, up 6.95%, as you can see there in green at the top. And year to date, enjoying 63.7% returns. Eli Lilly, you will find in your equity income models with us. And then down the line, you see Cintas, Waste Management, CSX, and McDonald's. I'm glad to see CXX moving its way back up the ranks. It's sort of been on our question mark category within the equity income model for the past few months. That said, quid pro quo, our losers for the week are Apple, Pentair, Nucor, one of our ETFs, which is a technology-based Aristocrat ETF. You've heard me talking about aristocrats. We're going to end this week's 3 for 3 talking about dogs for the Dow and our aristocrats and how they compare and contrast. With also bottom 5 of the losers this week, Illinois Tool Works, which does happen to be in our aristocrats model. That said, week in review, we didn't have that much economic data come out other than inflation, and it was nothing huge to write home about. We did see some core inflation tick up just slightly above expectations. However, with what came out with inflation, pretty much, and I know this is the story everyone's tired of hearing, but the interest rate story is the story of equity markets. We will not see equities start to take off again until we see interest rates start to decline. That said, in terms of week in review, I had the pleasure of seeing Bill Gross, who is dubbed the Bond King. Bill, now in his 79th year, was spry and fresh and in person and on stage. Just gave us great bits of information as well as belly laughs. And he actually shared that Powell's 2% inflation is a dream at this point, which also echoes my prior sentiments of, here with inflation, albeit it's come down from 9% to, hovering in that 4 to 4.5% area. To get to Powell's dream of 2 is going to take quite a lot within the consumer sector. What does that mean? That means that interest rates probably are not going to start to decline until we get closer to that Powell 2% inflation number. That being said, nobody sees a rate hike in September, so that's not bad news. That's the week in review. Let's grow. This is the second part of the segment. And these are 2 ETFs that I got to talk with the fund managers at the Future Proof Conference. I just thought it was interesting to bring these to light to you. Not only DMCY, which is a Democracy Investment Management Fund. I rubbed shoulders with Julie Kane, the fund manager there, as well as that of MUSQ, a music ETF. When we're talking about alpha and underperforming sectors that may offer a lot of value, really this MUSQ has my attention. If you think of the Netflix of the world vis-a-vis that of, say, Spotify, as you know, we all use and love music. And if you've seen what's now by Bloomberg being dubbed the Funflation index, which is that of individuals paying upwards of $300 to $1,500 to go to a Taylor Swift conference, or rather concert. Got conference on my mind. The MUSQ story is an interesting one because Spotify, for example, trades at, say, 45% that of, say, a Netflix. So valuations within the MUSQ portfolio, which does own the names of Google and Amazon and Apple, because they are players in the music space. But just something interesting to look at. I thought I would bring some growth ideas of some new funds that are coming to the market. The Democracy Investment Fund is one that's really interesting. It is eliminating countries within the portfolio and stocks within the portfolio that are representative of economies that are not considered high scoring within the democracy index as ranked by The Economist. So by growing here, not only does this maybe mean these are two investments that could potentially boost our portfolios going forward. Certainly, we're not including them just yet. But by growing, it just brings new and information to light about what's out there. Often I get clients inquiring as to how to invest with their values, and whether that be climate or no sin stocks. This democracy investment management, the Democracy Fund, is one I'd never thought of or heard of before. So this just takes that ESG, or that sustainable aspect of the market that some clients are seeking to be able to invest with their values. So this is an interesting new opportunity that I just thought I would mention, that we're exploring, not adding these to the portfolio just yet, but if anything, the takeaway is our eyes are always open. That said, this is a busy slide, but the fun facts is how we'll round the bend here today. Wanted to touch on dogs of the Dow, because I did see that, here's the fun fact. Well, a couple fun facts here, but I did see that Garden & Gun, our very own here in Charleston, South Carolina, our very own awesome publication, Garden & Gun's annual Good Dog Photo Contest is happening right now. So you can enter your dog and try and solicit votes to win their contest. So I placed Basil. You see the bloodhound Basil here from Fairhope, Alabama. I couldn't resist. Not only do I love a bloodhound, but my brother happened to be married in Fairhope, Alabama. All of the stock piece you see on this slide references Dogs of the Dow, which is actually a term whereby the 10 highest yielding stocks of the Dow are placed in a portfolio. I wanted to compare and contrast that to our Dividend Aristocrat model. Now, I know I've been blowing you up about our Dividend Aristocrat model. Yes, it's up over 26% year to date. But the differentiating factor between the Aristocrat model and, say, Dogs of the Dow, which is a popular sort of plug and play, there's ETFs out there, exchange traded funds, that offer the Dogs of the Dow strategy, but it's not necessarily a winning one. So in the far left of the screen, you can see that only 2 stocks, Intel and Cisco, are outperforming the S&P 500, or even a 60-40 blend year to date. Add to that only the likes of JP Morgan and Dow Chemical. So there's only 4 of the Dogs of the Dow that are actually beating the Dow Jones Industrial Average year to date. So you compare and contrast that here, predominantly here on the slide, that we have 1, 2, 3, 4, 5 names ahead of the S&P 500, followed by Caterpillar, Lowe's, Cardinal Health, Cintas, and Sherwin-Williams, which are all above the 60-40 and all above that of the Dow Jones Industrials, including Illinois Tool Works. We have 1 stock in the Aristocrat model, which is ADP, you see at the bottom of the barrel. So only 1 stock that's actually underperforming the Dow year to date. So it's important that when you consider a strategy like the other ETFs I mentioned, and or Dogs of the Dow, which could be trendy per se, that you really lift the hood and look inside, and especially when we continue with the theme of quality and dividend yield, because sometimes the highest dividend yielders is simply a function of the price of the stock being so low because it's sold off, because investors aren't liking the stock. So that's predominantly the case with these dogs of the Dow vis-a-vis that of just the high dividend payers found in the Aristocrat model. So sometimes just seeking the largest dividend paying stock is not always the best strategy. So with that, thank you for joining me with Friday 3 for 3. I know I'm not in 3 minutes. I'm working on it. Thanks for joining me. Make it a perfect weekend.